Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We'd like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is April 16th. Good morning, Andy.
Good morning, Jim.
How's it going today?
It's going well today.
Yes. Well, we had I want to say eventful month, but let's just focus on this just past week. We had an OPEC Plus agreement. We came into Monday. Why don't we start off by talking about the agreement itself and what you think is going to happen?
Okay, the agreement was only over the weekend. It seems like a month ago. But yeah, OPEC Plus came to an agreement with some prodding from the U.S. And you know what, Jim? I thought overall it was as good an agreement as they could have come up with, given what the fundamentals of the market is and how they can balance the market or fail to balance the market. The IEA pretty much pointed that out today in its in release of its report. I guess that was yesterday.
Yesterday, yep.
Yeah. Given the extent of the demand declines, it would have been impossible for OPEC Plus and the rest of the non-OPEC producers to balance the market. It just it wasn't going to happen. So that they were able to come up with an agreement, I think will be positive down the road. No doubt it'll be positive. Some of the numbers are certainly very suspect. There's a lot of like hopeful math involved in some of these production cuts. Some of these cuts are simply not going to happen. But nevertheless, production is going to be cut to some numbers, and it's going to serve to eventually help to balance this market.
Yeah, I'm quoting from the IEA report. Never before has the oil industry come this close to testing its logistics capacity to the limit. So I guess they're basically saying what you said, that the measures are encouraging, but they won't balance the market immediately.
No, they're not, and the market is certainly reflecting it in the pricing of the front end of WTI and Brent relative to the backs, and we'll be talking about that, I'm sure, at length, Jim.
Yeah.
When we start talking about these, when we talk about the spreads, but to me, as a longtime observer of these markets and a guy who has pretty much spent his career trying to do these balances, and I've never seen numbers that are this far apart, not only in terms of where the demand expectations are, but also where the supply expectations are. I used to be upset if I was off by 500,000 or 1 million barrels a day. Now we're looking at deltas of 10 to 20 million barrels a day on both the supply and the demand side, and that certainly makes it very difficult to do any type of price forecasting. But nevertheless, we keep trying.
Yes, we do.
Yeah, we keep trying. Yeah.
So the initial reaction on I guess we'll talk about WTI. The May contract was down but the rest of the curve was up. Particularly, you go out a few months, it was up over $1. So,
Right.
so that would, to me, I said, okay, that's probably makes sense. They're going to cut back a lot. Maybe we get some demand coming back third quarter of the year, and supply does meet demand, but it's probably too late for the May contract. I mean, what was your take on that?
Yeah, I agree with you. I mean, the May, we've got all these barrels coming in both in April and then again in May. So calendar April, and then again in May. So as a result, and crude runs are being cut. So the OPEC plus production cuts certainly are not going to come in, or will not have any effect on the spot month. Now, as supplies come in, crude supplies come in, and demand for crude in terms of run cuts goes down, obviously stocks are gonna build. Crude stocks are gonna build, and the spread between the front month and the back month is going to widen out. And we saw that. We saw that last week. We saw that early this week. We saw the May June get out to over $7 a barrel, which indicates that there's really no storage available, uncommitted storage available in Cushing. It since has rallied, but the market's telling us that it's really going to be filled up in the mid-continent. I think we said in our last podcast we were expecting it to be filled in May, and certainly latest June.
Yeah, we see a plus 19 million barrel number in crude oil this week in the weekly numbers, and the Cushing up 5 million. So are you saying that storage has got in Cushing, say, has got maybe 4 weeks, month and a half before they're filled to the brim? So is that what you're saying?
That's what it looks like. Yeah,
Yeah.
4 to 6 weeks will be filled to the brim at Cushing. Now there still looks like there's some storage available in the Gulf Coast, Pad 1 and Pad 5. There's storage, but it doesn't matter that much. So yeah, and we're seeing that in some of if you look at some of the grades, the contango on the grades, the carry on some of the grades like LLS or Houston is not quite as wide as where it is on WTI. So there's storage along the Gulf Coast, but that's going to get filled too.
Yeah, and that's where the government has offered, what, 20 million barrels of storage, something like that.
Yeah,
That's
right.
In the Gulf Coast area.
Right.
Well.
The government is the government's offering strategic reserve storage in the salt caverns along the Gulf Coast, which is, I think, a great idea, Jim.
Yeah, right. I do too. I think they should have done that. They should be do that on a regular basis if they can, if there's demand for it. But I just want to point out that on Tuesday we saw some massive liquidation of the spread options. Some people have been buying deep out of the money puts on the May-June spread, only to see them go deep into the money. So they started with a -4 strike all the way down to the -650 strike. And on Tuesday, we saw about almost 14,000 lots of open interest decline. So that's a big number for the spread options. I mean, it's not the only thing going on. It's also possible they're buying when these things go deep in the money. They want to get out. They don't like the bid offer spread. They're so deep in the money they can buy the spread against it. They can buy the May-June spread futures. So that could be why we've seen a little bit of a bounce in the spread. And then the last piece of that is today is the WTI, the May option expiration, and those puts have gone in the money. The absolute prices, flat prices, gone down sharply. If you're long a put, like if you're a producer, there's no rush for you to get out. You just let it keep going. If you're short the put, you probably covered it in some way already. So they're sitting out there. They probably, if you're deep in the money, you're probably going to buy futures against it, and that might be what's giving May a little strength right now, because the fundamentals, as you just mentioned, don't point to any help on the way for the May contract, right?
No, for the May contract, which is going off next week, but even for the June contract also,
Yeah. So yeah.
there's nothing on the horizon for either May or June that's particular that in the near term
Yes.
is going to change the the supply and demand for crude at Cushing, or even the Gulf Coast is going to get full or close to full because all these long haul imports are going to be arriving. All these Saudi barrels, which were sent in sent in March, they're arriving in April and into May, and they're going to keep coming until in June they'll start abating. But
Yeah.
and we don't need them. I mean,
No.
we clearly do not need them.
Yeah.
We're already seeing a huge decline in crude runs, and and we're going to continue crude runs, and that gets we'll talk about the product balances. We still haven't reduced crude runs enough to balance the product markets. So what crude runs are basically a demand for crude, and they continue to go down.
Yes.
Sorry about that.
It's okay. We saw almost a million. Was it almost a million barrel drop this week from the weekly numbers? We're at 12.6, 12.7 now.
Yeah, crude runs have fallen off the table, and it does not look as though they're not going to start coming back until June or July at the earliest, which is why our numbers look like we're still seeing rising crude stocks right through June and possibly into July, and that's with production declining pretty dramatically. What the EIA has is that production is down from earlier in the year 12.7 million barrels a day down to 11.8 by the end of the second quarter, and I think that's certainly feasible. Could be lower than that.
Yeah, they're running out of places there's no demand. There's no places to put it. We'll start seeing ships in the Gulf not offloading but trading the curve, as long as
floating storage, right?
Yeah,
if you can find a ship and make the economics work.
So I guess we want to know what month does it turn around, and we're probably going to get get more information about what month is going to stop going down by listening to Dr. Fauci rather than some of the numbers, right? When he says it's okay to open up the economy.
Right. Well, gasoline's a real problem, Jim. It's a real problem because we're already we're 260 some odd million barrels of gasoline, and it looks to be like the government has 273 as the Shell storage number. I think it's probably closer to 280, 285. I think by the end of May or into June, it's possible we get there. Which is, again, how do you crank? You can't crank the crude runs up if your gasoline storage is full. And
exports aren't going to bail you out.
No. I mean, exports are not going to bail you out whatsoever. The only thing what's going to bail you out is that you reduce crude runs enough to at least try to balance the market, but then you build crude stocks,
right?
So it's really a dilemma. It's a really tough dilemma for the refiners who are facing horrendous margins as it is.
I remember we were trying, everybody was trying to get Exxon's futures business, and they'd said they'd never hedged because they were internally hedged. They had all this refining, they had petrochemicals, they had oil production and natural gas production all around the world. And so if oil prices were going down, their margins were going up. If maybe natural gas would be doing better than crude, but this time there's no place to hide. It's like you're all of your assets are correlated, and they're not doing so good.
No,
Right.
there's no way. There's no way out, at least in the near term. As we
Right.
move forward,
Right.
those long haul barrels won't be coming here. The Saudis are focused on Asia, rightly so. So that the production will decline. We'll see what the Texas Railroad Commission decides. They've been under pressure to cut Texas production by 1 million barrels a day. We'll see if that happens. But the market itself, I think, is gonna take care of a lot of this excess U.S. production, given
Yeah,
where the demand is.
right. You'd kind of want. I mean, that's kind of you want the market to do its work. The higher cost producers stop producing first.
Yeah,
Yeah. Oh,
and
yep. Go ahead.
the again, that could be by the end of the year. That could be 1.5 million barrels a day out of the U.S. balances, and that certainly will help.
Yep.
And
Yep.
maybe it'll be 2 million by first quarter.
Right. Before we talk about the snapback potential, let's talk about products for a second. I was looking at the weekly DOE numbers, stock levels. It's on their site this week in petroleum. They got some really nice charts there. And if you look at crude oil, it's obviously moving. Stock levels are moving sharply higher. Not quite. They're approaching the sort of the 5-year top of the range. Gasoline, however, has blown through, as you mentioned, it's a problem, blown through the top of the 5-year range. But diesel, even though it was a hefty increase lot this past week, is still sitting at that bottom part of the 5-year average range. But the prices are acting. Gasoline's been gaining on diesel recently. What's going on there?
That is a excellent question, Jim, because the gasoline crack has rallied $10 this week from way negative or over the last couple of weeks. Of course, it was negative,
Right.
and now it's moved into positive territory, and it's really unclear why, unless the market's telling us that refiners have cut back enough on gasoline, or demand is not as bad as we think. Although I can't imagine that the demand is any better than what the EIA is reporting. And again, we're looking for gasoline stocks to continue to build. Now, diesel was a bright light because trucking demand, at least during March and into early April, was pretty good. Diesel demand was hanging in there, and as a result, the diesel crack really was strong. But now, yeah, every refiner that possibly could is going to try to run for diesel, and maybe the gasoline cracks reflecting that also. We're seeing diesel production was up this last week to a pretty
Wow.
high number, and it's unclear given how all these supply chains are completely broken. How diesel demand is going to continue to stay as strong as it was in March until until the economy opens up again. So we could see diesel going the other way, Jim. I mean, it could go. We could start seeing diesel going south here as refiners run for diesel.
Right. Very good. So why don't we move through the year and let's talk about, at some point we do open up the economy gradually. When do you have this coming into balance?
The big
Or
problem
yeah,
is the imbalance in the second quarter. And this is, the IEA had us building stocks, I think something like 15 million barrels a day in the second quarter. OPEC was less. And the IEA, OPEC, I think, was only like 10 million barrels a day build, which is outrageous. I mean, that's an outrageous number.
right.
None of us have ever seen anything like that, which would indicate, every nook and cranny after the second quarter is going to be filled, and I think that's going to continue into the early third quarter. And then it looks as though, if non-OPEC production continues to be cut, and we're talking about reductions in Canada, in Norway, U.S. of course, Brazil. By the second half, we'll see non-OPEC production really coming off, and OPEC production. They're not going to make 997 out of OPEC. I mean, some of those production cuts. Nigeria, if they can sell, they'll sell. Saudi, I think, will cut back, but UAE, Kuwait also will cut back. Iraq, they're not going to make their number either unless demand for their crude is less liftings are off because the demand is so soft. But it looks to us as though in the third quarter, later in the third quarter, things get a little bit more into balance. And then we have a deficit in the fourth quarter. Ours is like 2 to 3 million barrels a day. The IEA is looking at 5 million barrels a day. And again, it's all predicated on how the economy bounces back, and how demand bounces back. I have it not bouncing back that strong by fourth quarter. I think the IEA and OPEC definitely is much more optimistic for fourth quarter demand.
Yeah, and then you have all this stock overhang that you have to start liquidating. So that
Yeah, let's talk about that. So here we are. Our stocks globally will be full, and this deficit, it's 2 million, 3 million barrels a day. Well, we just built by 10 to 15 million barrels a day. So it's going to take a long time to work off this surplus. So it's going to be, might be into next year, or second half of next year before we get inventories back anywhere near normal.
mm. Yeah, I was talking to you about this. It's different when you're looking at the stock market where you're buying a financial, like let's say you're buying some stock, and you're kind of discounting future earnings, and in futures it's different because you have they're contracts. You're trading contracts, and they go off the board. So you buy May, and all this good stuff from OPEC cutting back can't help May because it's not going to kick in till second half of the year where we get more
Right.
balance, right? And so you have to be careful, what actually you buy. And you think about all that money that went into the U.S. oil stock, that's basically futures rolling. So they're not only did the market, the flat price come down, but now you have these steeply market in contango. So every time you roll, you're losing money. So it's just have to be careful on where, if you're bullish, how do you play this thing?
Right. How do you describe your bullishness? The market will recover. It's just
When and how,
and I
yeah.
think it's a long it's a long slog till we get out of this. The good news, the longer term, it's good. It's good and bad news. Obviously, is a lot of is we're seeing capex just being crushed.
Right.
Tens of billions of dollars. I think it's 65 billion. Maybe it's more than that. capital expenditures that won't be made, which is going to lead ultimately to a longer term bullish market. It's just when that cycle begins.
Yeah, that's what we're all trying to figure out here. I looked quickly through some of the options that traded yesterday. I did see a December $70 call. I didn't check it too closely, but I was just looking for kind of oddball things that were trading. So I don't know if you call him an optimist or a pessimist, but somebody who thinks that we're going to see a big turnaround by the end of the year, and that would be November. Those things go off in November. I saw some June 2023 $41 calls and DEACE 2021 $39.50 calls. So some people are looking, trying to take advantage and doing exactly what you're saying. There's a recovery coming. When, and I don't know, it looks like they're trying to take advantage of that idea. And what else? We saw had some puts that traded that were kind of not oddball, but the June 2021 $30, $45, and $50 puts. So that might be somebody taking, a producer looking at the curve, better prices in the years out, and just putting something on. But other than that, the big open interest numbers and options are still the June and D's 40, 45, 50, 55 puts, and the June and D's 50, 55, 60, 65 calls. The June 10, 15, and 20s are on the rise. You just haven't been down here long enough for those to pick up an open interest. So you will see. It's so odd. The volumes aren't crazy. We did a big number on the way down on March 9th, over 500,000, but most of the time it's between 150 and 200,000. And, those are good numbers, but not out, crazy numbers. We had a new vol record set on March 20th. The front month was up to 188.
Oh.
The second month, what I track was 153. And yesterday, June settled at 112. So, we're way off the highs, but it's still over 100%. So everywhere you look in this market, the numbers are just crazy. I mean, it's truly is an oh my God market, which I have made fun of for a lot of years. That people are going, oh my God, when the market moves, they said, this is nothing. This is something.
This is something. No, this is one for the books. We've been in this, at least I've been in this pretty much from the beginning of crude. Actually, even before that, I hate to say it.
Heating oil, 1978, Andy.
I didn't start in 78, but close.
Okay.
Close.
I thought you were
close, but yeah, this is definitely one for the books.
Yeah. Very good. What else? What else do you want to talk about?
Well, the one other thing I want to talk about, and we brought this up, is can the market go to zero?
Yes.
We came pretty close on some of these. Some of the other crudes, Canadian crude, came close. What physical gasoline came really close to going negative. In Chicago, in I think the end of the month or early in the month, the gasoline went for 16 cents. That's 16 cents. And I think in North Dakota today, it was 14 cents. It's amazing. It's almost as if you get to the point where you're paying somebody to just take it away.
I thought you were going to say it's almost like, what was it, Oil City, when the oil was first discovered? Is that, I can't remember.
Yeah, the Drake well. As a matter of fact, in the 1860s, oil did go negative. People did pay to take it. There was no storage, and producers paid to get it out.
I think they said you can keep the barrels.
Yeah, you can keep the barrels, right?
Yeah. Very good. Yeah. So, okay. Well, we had our special podcast a couple of weeks ago with Andy Furman. He's talking about what hedgers are doing. So if you hadn't listened to that, that's still timely, and he's got a good approach to risk, and he talks to all different kinds of participants in the oil industry on a regular basis. And so it was good to get his insights. And we're probably going to do another podcast in another month, Andy,
Yeah,
or
if not sooner,
if
maybe
not
sooner.
sooner, maybe soon,
Yeah,
maybe 2 weeks.
maybe sooner. There's a lot to
Yeah.
talk about.
Yes,
Yeah,
there
and
is.
we'll try to get some guests on as well.
And I'm still putting my favorite articles and my sometimes I'm not too snarky, I have to say. More snarky in person than I am on the blog, but there's stuff going up on the blog on a regular basis, and that's at commodityresearchgroup.com. And anything else, Andy?
No, I think we covered a lot, and
Okay.
there's certainly a lot to cover.
Sounds good. Okay, so we'll catch you the next time. This is commodityresearchgroup.com.